Well, I look at EM as an entire asset class. I'm no expert on Brazil specifically, but I am bullish on EM. And just to give you a little backdrop, from 2011 to 2016, EM underperformed the U.S. or the global market consistently for about 5 years and by about 150 percentage points. And now for the first time since 2011, we're in this global synchronized reflation driven by China. I mean, China is at the center of this, not Brazil or any other specific country. And the fundamentals are much better, but this is a good reminder why EM trades at a 12 multiple and not an 18 multiple, which is where the U.S. trades, because they are emerging markets and these things happen, although they can happen in developed markets as well, of course, as we're finding out. But the fundamentals are good. We have some global tailwinds. Yes.
Jurrien, how can you be positive on EM if you're worried about China?
I'm not worried about China. All I'm saying is that credit impulse, this is the third one since '08, and it is now waning. You get this shot of adrenaline, and then it goes away, and then things sort of settle down because the economy overheats. But as Megan said, I don't think at this point China is at risk. Maybe a year or two down, the China tends to go through these shorter cycles than developed markets do. But we're kind of on the other side of a big credit impulse, and I think the long-term risk for China is real. Just to give you a sense, in '07, it would take 6 trillion RMB of new credit growth to generate 5 trillion RMB of GDP growth. Today, it takes 18 trillion of credit growth to produce about 6 trillion of GDP growth. So that credit lever that they use and keep going back to, eventually it's going to create problems, but I don't think that's a 2017 story.
I was told earlier this week the best performing emerging market currency was sterling.
Yeah.
That's what I got told earlier this week. Jurrien Timmer, talk to me about how you allocate to emerging markets. You say you don't know much about Brazil, so are we talking a blanket EM long via an index, via an ETF? Is that how you're playing this?
It's all relative to how you're benchmarked, not to get overly concerned about benchmarks, but if you're a 60-40 investor, 60 equities, 40 bonds, and within that 60, let's say you're 40 US, 20 non-US, and out of that 20, you're half EM and half developed. I'm just giving an example. I would be overweight EM and really non-US developed stocks, including Europe, and we've talked about Europe many times in the past couple of months, relative to US. So I think the US is an underweight and non-US and especially EM is an overweight, but that's relative to how you would normally be invested, not necessarily against some absolute benchmark like cash or something like that.